Welcome back to Street Smart. The Federal Reserve is sending signals that rates will stay low for the time being. Combine that with more good earnings news from companies like Dell, and stocks are on their way to snapping a three-day losing streak. It's no surprise to our next guest, one of the most bullish strategists that we survey, calling for an S&P 500 at 1475 by year's end. That would be 10% above where we are now. Joining us is Tom Lee, Chief U.S. Equity Strategist at JPMorgan Chase. Tom, thanks for coming on the program. Let me ask you first about Scott Minerd's comments. He was just on with us. He's very bullish as well over the long term, but he does see a correction or a significant pullback this year before we return to levels higher than we're watching now. What do you say to people who suggest that that's a possibility?
I mean, corrections are pretty normal, in bull markets, and I'm not sure what kind of magnitude he's talking about. We think that the pullback we had earlier this year to 1250 really represented the type of correction that you do see once a year in a bull market. So, I mean, it's sort of our view that, there's a very good chance that we sort of have congestion June to September for markets, but nothing approaching a 10% correction from here. Isn't
the news around the globe too depressing for a gain to 1475? I mean, the housing news we've been discussing this week with a drop in starts, an 11% drop in starts, doesn't bode well again for the U.S. housing market. The Bank of Japan has obviously serious problems with its economy there, and we're looking at a soft reprofiling, possibly domino effect around Europe, which is obviously really a default. So with all of these things going on, why would you think we could get to 1475 here in the U.S.?
Yeah, it's a good question. I mean, first of all, you're never going to have a robust move in markets when all the tea leaves are lined up, because at that point the market's probably exhausted its upward energy. If you kind of work through those issues, I mean, in terms of housing, I think what's really much more important to housing is not starts right now. It's really credit creation. In other words, are banks easing, and we know banks are easing, and that it takes, when they started to ease on credit card and installment debt, it took about 6 months before you really saw demand pick up. I think we're in the same situation. And in housing, it's household formation, which is really a result of jobs. So I look forward and I say I think housing is going to look vastly improved, 6 months from now. And then in terms of Japan, Japan had a huge seismic shock. I mean, almost a 16% drop in industrial production on an economy that's equal to the size of China is certainly going to send ripples globally. And I think a lot of what we're seeing in terms of claims and the downturn in the PMIs reflects Japan just as much as it reflects oil.
I think your take on housing is interesting, if only because you're one of the only people I've heard say that. You think we're going to see a significant housing recovery next year, and that's what's going to propel stocks higher. How do you leverage that bet? What are you doing to put money on that?
Well, first of all, you have to remember housing is extremely labor intensive. Every time you increase starts by 250,000, it's 1 million jobs. So really, when you're playing housing, you're playing not only huge resource intensity, which is domestic basic materials, whether it's paper or if it's PVC, but it's also things that are sensitive to labor recovery. So I mean, I think it very much looks like a domestic cyclical play to way to leverage it. And of course, buying home builders directly obviously is a way to really maximize that bet.
Just to mention Scott again, I didn't get to ask him something, but he thinks that Europe will have a crisis worse than the Great Recession here. Do you think that if we see a European crisis, if we see a domino effect over there with defaults, that the U.S. economy can weather that storm, that U.S. companies can keep earnings growth?
I mean, if there is I didn't really sort of follow his complete comments, but, Europe's markets aren't really signaling a deep downturn. Normally, you would see some sort of inverted yield curve if you're going to have a huge recession. It's just very similar to U.S. in terms of signaling. And I think a lot of the depth of that decline really depends on monetary adjustment as well as what happens to the exchange rate. So, if Europe does have a huge recession, that's a huge if. It would have effect on the global economy, because in aggregate it's an $11 trillion economy, so it would be an issue. But I'd say maybe I'm just not sure I agree with the idea that a great recession is going to take place there.
You don't think it's a very strong if?
Correct.
Tom, thanks so much for joining us. Really appreciate it. Thomas Lee there from JPMorgan Chase, Chief U.S. Equity Strategist of the bank.